Oh, we got Jeffrey with us.
Hey.
How are we doing?
Just another day in paradise.
Yeah, another day in paradise is right. I don't know if you guys were feeling this or not. We don't have to look at this, but this is Alex's show, so I'm gonna let him make the
Uh,
decision. But we got this guy coming on.
yeah, just a
Yeah,
second, pal. Gonna get up there and talk, and we already did a stop clear to the top and to the bottom, so we'll see what
Yep.
happens.
yeah, let me get my everything pulled up here.
Yeah, and
Nice little
feel free
pop,
to.
and then just a little sell off, and now we're kind of coming up again.
My colleagues
Um, let's see. I was gonna try and stream this while we.
of maximum employment
Where is?
prices for the benefit of the American people.
I need to find a good link. FOMC stream.
Um,
It has edged up.
Alex, if you go
Job
on
gains have
YouTube
slowed,
and you just
and
look up the
downside
Federal
risks in
Reserve,
employment have
they've
risen.
got the best stream.
At the same
I got
time,
it.
inflation
You got
has
it?
risen recently.
Yeah.
and
In
remains
contrast,
somewhat
business
elevated.
investment in equipment and intangibles has
In
picked
support of
up
our
from
goals,
last
and
year's
in light of the
pace.
shift in the balance of risks,
Activity in the
the
housing
Housing
sector remains
Market
weak.
Committee
Hey,
decided
pause
to
yours, Blake.
In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level.
Relatively
Payroll
low.
job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation.
I can hear it.
Labor
Yeah.
demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the market slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run
Ooh,
goal.
market likes that inflation.
Mhm.
It's based on the Consumer Price Index, and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up.
Uh-oh.
In contrast,
This is a
disinflation
bullish price pattern.
for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The
Should like
median
that.
projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived. A one-time
Short-lived.
Short-lived.
But the inflationary effects could instead
I am a robot.
Yeah.
AI Powell.
diminish. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, Risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation.
Oh, that was great.
When our goals are
Mhm.
like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Boring.
Yeah.
Well, you seem sad.
He did seem a little sad, didn't he?
Has continued, kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
Good question.
So, we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Cool.
Ooh, okay.
You and other Fed officials have spoken extensively about the impact of tariffs on inflation. Although perhaps with many companies appearing to meet the tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation?
It's certainly possible. We have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And it's also possible that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply. And to the point where we see what I've called a curious balance. Typically when we say things are in balance, that sounds good. But in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate.
They do not like that.
Mm-mm.
Why is job demand lower? That's a problem.
That is a problem.
I'll just leave that there. No explanation.
Yeah.
So I don't think we can say.
I follow this guy on Twitter.
What we can say is this: that over the course of this year, we've kept our policy at a restrictive level, and people have different views,
no crap.
a clearly restrictive level, I would say. So, and we were
Sort
able
of.
to do that over the course of this year because the labor market is in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, you can I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that. But we do know that they've moved meaningfully toward greater equality, risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
In what circumstances would a larger than 25 basis points rate cut be warranted? And how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. I think we've done very large rate hikes and very large rate cuts in the last 5 years. And you tend to those at a time when we feel that policy is a place and needs to move quickly in place. That's not at all.
Internet. Dang it.
Could be the Fed side too.
It was a quarter point cut, just in case anybody didn't hear,
Yeah.
didn't hear before. Like that was, he was just jawboning about why they did what they did. But they announced at 2:00 a quarter point cut and potentially 2 more cuts before the end of the year.
Mm-hmm.
We're back. Oh, can't say that on here. Wow, Southern, they don't like something he's saying. Look at that. Big old red candlestick.
Yeah, whatever he just said isn't going down too good.
Yeah. Damn it. I don't
It
know.
might be better on YouTube.
Drop the link.
Yeah. There.
Yeah, Pete. No, there's a rate cut coming, Pete. All right, it's already here.
Yeah, it just happened.
Here you go.
You got it?
We'll see.
So I just sent you the link for YouTube.
Forecast for unemployment didn't change.
Yeah, I think you could think of this in a way.
I could just click the YouTube.
Because he actually
I didn't even see that on there.
the projections for growth has actually ticked up just as he's been looking.
All right.
These people actually have some good questions today.
Back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressure of picking off a series of cuts at this point.
Yeah, so I would look at it this way. We fully understand and appreciate that we need to remain fully committed to restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed.
He just said the opposite a minute ago. He said that there's a risk of higher inflation. Now he just said there's a risk of lower.
Dude,
and in terms of,
I feel like this is like almost like a nothing burger meeting, man.
It is
relatively low rate, but we're seeing downside risks.
We cut just enough to keep Trump from being angry, and
yeah,
and
we have no insight into the economy at all. Inflation might go up or go down.
Nothing really. I mean, talked about the job numbers. We all saw that.
What's happening in the employment area is related to immigration, which your rate cuts wouldn't address.
That's a good question right there, bud.
As more important than inflation, which has remained almost a full percentage point above your target.
But I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was going to say. So I wouldn't say that all of what's happening in the labor market is due to tariffs. And you clearly have a slowing in due to immigration. You clearly have a slowing in demand, which is now perhaps more than that, but in supply. And we know that because the unemployment rate has ticked up. So, that's how that's what I thought about that.
Follow up. Every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest
Woo!
percent target is not really achievable? And is there any credibility problems?
No, Bloomberg, you're going to destroy the bull market.
That's what you're going to do. You can never reach it.
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028, but that's, that's literally how you put the projections together. You're writing down a rate path, which is designed to create over the course of the SEP, time frame, 2%.
Don't bother me with the numbers. It's all statistics.
Yeah. Yeah.
Who knows where the economy will be in 3 years? But the nature
Oh my gosh.
is to
No one really knows.
No one knows.
at least by the end of the exercise.
So much, Elizabeth Schulte with ABC News. The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
Well, our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that the effect, basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much every forecast, all the individual forecasts say that.
What?
We can't just assume that though, right? We have to. Our job is literally to make sure that that is what happens, and we will do that job. Right now, the situation we're in is that we see inflation. We continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass through of the tariffs into inflation has been slower and smaller. The labor market has softened, so the case for there being a persistent inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates and we try to balance them. For a long time, our framework says that when our two goals are in tension, this is quite an unusual situation. How do we decide what to do? Because our tools can't do two things at once. What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal. So, and then we think about those things and we see, as I mentioned, our policy have been really skewed toward inflation for a long time, really. Now we see that there's downside risk clearly in the labor market, and so we're moving in the direction of more neutral policy.
All right, labor market risks.
This isn't a hawkish meeting so far.
This is not.
It's not.
Obviously, we think it's appropriate.
Yeah, hawkish would be for higher rates.
Yeah.
You know,
Like,
I mean, they already
dovish.
they expect 2 more rate cuts, so I mean, it's like
This is a dovish meeting.
People who are sort of more at the margins, so kids coming out of college.
he's essentially downplaying the fact that we still have inflation and that what they're doing will cause more inflation and
Right.
Exactly. That's
focusing
exactly
on
right.
and just focusing on the weak jobs, and the market's not liking that so far.
Environment and concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on, so that could very quickly flow into
There you go.
into higher
There's some
unemployment.
hawkish statements.
Healthier economy, healthier labor market, there will be jobs for those people, but now the hiring rate is very, very low. So that's been a growing concern over the last few months. And it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
I see like a mix between being hawkish and dovish.
Yeah, I mean, this is like a nothing burger.
Yeah, that's exactly. It's like neutral.
What I figured would happen though. Like
Yeah.
they don't want to. He doesn't want to move the market.
Yeah.
We did not use it this time. And in fact, when you said policy is not a preset course, did you mean that is sort of the opposite of recalibration? Are we meeting data point by data point? Are we in the
Let's
process
ask the crowd.
of getting back to neutral? Thank you.
So I think we're in a meeting by meeting situation. We're going to be looking at the data. Let me say a word about the SEP really here. So we often point this out. What the SEP is, it's an accumulation of the individual projections of 19 people, showing what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. And as you know, we don't debate or try to agree on what that is. We just write them down, accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path that would really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the
Poll.
risks.
Everybody answer that poll.
On decisions, actually. So you will have seen that we have 10 participants.
And hawkish means higher rates, dovish means lower rates.
Four cuts for the remainder of the year, and 9 who wrote down fewer than, in fact, in a good number of cases, no more cuts. So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability. And so there are different possible outcomes and likelihoods rather than this one is certain and this one isn't happening. So that's what I would say. For getting
Look at that.
Dispersion in the outlook, a sign of uncertainty.
Bonds ripping.
Yeah, I was gonna say 10 years up.
Yep.
I just saw these flows coming in on gold too,
Yeah, gold's been ripping, yeah.
Inflation is low,
but gold's actually down.
labor market is really
Dang,
strong.
TLT's selling off though.
So
Yeah.
we have a situation where we have two-sided risk, and that means
Yeah,
there's
gold's
no-
down for the day, but it was coming up off the lows. It sold off heavy this morning.
And it's
Did.
not surprising to me that you have a range of views. It's not so much about having different views for the path of the economy, but it's partly that, but it's also partly about what's the right thing to do in light of this, the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based on, in this kind of highly unusual situation, and we do. So, but we get together, we discuss, we have a great discussion, and then we decide what to do and we act. But you're right, that it's a wide dispersion of views, and I think that's understandable and natural in current situations.
Hi, Victoria Guida with Politico. You've talked a lot about Fed independence and the importance of it over the years, but as markets have questions about what exactly President Trump's intentions are with the Fed, what would you point to as the things they should be watching to determine that the Fed is still making decisions based on, the economic outlook rather than political considerations?
Look, it's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just everybody who's at the Fed really feels strongly about that way. So, you'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do. And we don't frame these questions at all or see them in terms of political outcomes. When you get to another part of Washington, everything is seen through the lens of does it help or hurt this political party, this politician. That's the framework. And I think people find it hard to believe that that is not at all the way we think about things at the Fed. We're taking a longer perspective. We're trying to, serve the American people as best we can. So I think you would be able to tell. I don't believe we'll ever get to that place. I would say we're doing our work.
DIA holding up kind of the best.
People they're making their arguments and we're having a really.
Russell's still green.
So,
what's the ticker for that again? Russell.
The court case.
RUT.
2 questions of Fed independence.
Well, there's the results from the crowd. Dovish.
Yeah. I mean, he's like hawkish on the economy, I guess.
That's a mix.
Thanks, Mr. Chairman. Edward Morris, Fox Business. So we saw that.
Yeah, I'm actually watching the Russell futures, which is RTY.
RTY.
The revisions for June.
Small caps, baby.
Revisions we've seen since December of 2020. How can the Fed base important?
I mean, it's dropping, but it's still green on the day.
It is.
Trades on data that seems to be, as you called it, the past noise.
It's not a high volume sell off either.
The revision that we saw was almost exactly what we expected. It was amazing how close the expectation was.
Making trades.
For the last bunch of quarters, there's been almost a predictable overcount. And I think the Bureau of Labor Statistics.
Here we go.
Understand this and working hard.
Is this the
fix it.
rip?
It's got to do.
Could be.
Nothing to do with low response rates. It's also got to do with what's called the birth death model. Because a good amount of job creation happens around new companies, and how many go out of business, how many have founded, and it's just really hard. You can't survey for that. You've got to have a model that predicts that.
A model. This is why it's all fake.
When the economy is it changes.
Gold is gold getting hit right now? Oh, it is.
Yeah, is still well good enough for us to do our work. To the extent we have issues around data right now, it's about low response rates. That's happening all over.
Damn.
All over, really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to.
Yeah, I thought gold might have topped out about 37.
To get that is to make sure that the agencies that collect the data have sufficient resources.
Everything's selling off. Bitcoin, gold.
Yeah.
Yep. This is
That's what it takes.
coordinated flush out. Usually you sell everything and then figure it out later.
Yeah. Rip tomorrow, maybe?
Response rate is quite low for the first
No.
Turn around Tuesday. I mean, wait. Turn around Thursday?
Yeah, that is a real thing.
Thirsty Thursday. Everybody wants to get their beaks wet again.
Yep.
Second, so third month. So it's not that we don't get data. It's just
And the first big dip after all-time high is viable.
Mm-hmm.
Well, for the benchmarks, if that holds, it's 50% of the jobs that we thought were there weren't really there. It shows a weaker job market coming into this year. If you would have had that information, would it have changed your mind related to where the interest rates should be?
Oh, this is a good question, actually. Let's see this.
We have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and we take appropriate action, and we took that appropriate action today.
Thanks, Howard Schneider with Reuters. So, as you mentioned a minute ago, some markers of the job market would suggest that these signs are already happening. The black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a quarter percentage point now is going to arrest that?
Well, I hadn't say that I thought a quarter point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And markets has already been baking in expectations. I mean, our market works through expectations. So
I lost $100 betting that nothing would happen today. I set up a Kalshi account and everything.
Oh, you took that. You took that bet.
Yeah.
The odds were ridiculous, though. If you had won, like
I know.
Paid nice.
One of the reasons, in addition to just lower.
Looks like Euro USD topped out, starting to pull back.
That's the end doing.
Some part of the significant decline in labor force participation over the past year has probably been cyclical in nature rather than just the usual aging process. So we put all this together, and we see that the labor market is softening, and we don't need it to soften anymore than we want to. So we use our tools, and
premiums on these puts are just tanking.
Rate cut, but the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up to that, the growth.
This guy's got swag.
Very concentrated investment, and a consumer spending side, higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
I wouldn't say that. I mean, you're right.
Ooh,
those are two.
Look at that.
We're getting unusually large amounts of economic activity through the AI build out and corporate investment.
We're back on green for Dow.
For now, that will go on. No one does.
And
in
Rut.
terms of spending, you saw the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, it's spending. So I mean, I think the economy is moving along. Economic growth is going to be 1.5% and 1.5% or better this year, maybe a little better. Forecasts have been coming up, as you can see. So labor market unemployment is low. but downside risks, but it's still low unemployment rate. So
Ooh, look at that.
that's how we see it.
TM is clocking.
Mm-hmm.
Hi, Stephanie Rule, MSNBC.
Hi, Stephanie.
Treasury Secretary
Hey.
has said that the Federal Reserve suffers from mission creep and institutional bloat. He's now calling for an independent review. Would you support an independent review, or are you open to any sort of reform in any areas of that?
What does that have to do with anything?
Really, any officer says. So in terms of reform at the Fed, we just went through.
I just looked it up. Powell is worth $55 million.
Yeah.
Monetary policy framework. I would say
You don't want the market to tank. That's always money.
The assets we have in the Federal Reserve Bank Federal Reserve system and at the board, are they the right size? We're actually going through a 10% headcount reduction through the whole Fed, including board and all the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So
Look at that. Look at that retrace on SPY.
About the criticism.
That's crazy.
Ways to do our jobs better.
Right back up damn near to the open. Excuse me.
It's flat.
Yeah.
We missed the dip.
I mean, it could have been the dip that kept on dipping, though. You never know with old Jerome.
On whether AI is already starting to affect the labor market in terms of lower labor demand, high productivity by contrast.
Okay, Neil. Let's see what Neil asks.
And if that is true, does that have implications for the monetary policy setting?
So there's great uncertainty around that. I think my view, which is also a bit of a guess, but widely shared, I think, is that you are seeing some effects, but it's not the main thing driving it. And so particular focus on young people coming out of college, and there may be something there. It may be that companies or other institutions that have been hiring younger people right out of college are able to use AI that more than they have in the past. That may be part of the story. It's also part of the story, though, that job creation more broadly has slowed down. The economy has slowed down, and so it's probably a number of things. But yeah, it's probably a factor. Hard to say how big it is.
You think it'd have like a cooler looking room? It looks like a community center classroom.
It looks like a gym or something.
Yeah,
it's the government, bro.
Yeah.
You ever been in a government building? They're freaking
Last year,
weird.
Depressing.
Yeah.
It's always built by the lowest bidder.
Yeah.
Uh-huh. Absolutely.
And it's still 20 times more expensive than if the private sector did it.
That was not
Yes.
Yeah. Goods inflation went very high. We had essentially returned to zero or slightly negative inflation. Now, I think goods inflation over the course of the past year is 1.2%, which doesn't sound like a lot, but it's a big change. So we think, the analysts have different views, but we think it's contributing, 0.3 or 0.4 or something like that to the current core PCE inflation reading, which is 2.9%. So it's contributing. What seems to be happening is that, the tariffs are mostly not being paid by exporters, mostly being paid by really the companies.
Well, Linda, what do you think's going to happen tomorrow? What do you expect on the jobs?
Right.
You buy something and you sell it to retail, or you use it to make products.
Oh.
Taking a lot of those costs on and not able to pass it fully on to the consumer yet. That appears to be what we're seeing. All of those companies and entities in the middle, they'll tell you that they have every intention of passing that through in time, but they're not doing that. To the consumer, the pass through has been pretty small. It's been slower and smaller than we thought. But the evidence is very clear that there's some pass through.
I also wanted to ask if you could share with us the conditions under which you might consider leaving the Fed in May.
I have nothing new on that for you today.
Hi, Katarina Sarajevo with Bloomberg News. I just wanted to follow up on, one of your answers just a couple minutes ago. We've often heard you talk about how you and your colleagues, do not think about politics. This does not enter the room. But one of your new colleagues does come from this world, right, where everything is seen through this framework of politics and of what party is being helped, and that person is still employed by the White House.
Oh my gosh.
How can markets and the public interpret some of
Who are they talking about?
his speeches, for example?
Mirren.
Oh, that's right. Yeah, he was the one that said 50. He wanted 50 basis points. He was the dissenter.
Yeah. He was adamant about a 50-point cut.
Yeah.
Yeah. Imagine if they did the 50-point cut today, this market would have been
Public that are trying to
flying.
what you guys are saying.
So there's 12 vote, 19 participants of whom 12 vote, as you know, on a rotating basis. So no one.
The crazy part is there's still liquidity sitting at all-time highs that the market hasn't grabbed yet.
Really?
Yeah.
Yeah.
Ground is to be incredibly.
QQQ is still beat down here.
Is it?
Work is to make really strong arguments based on.
Look at the day, the whole day.
Yeah.
Yeah.
Look at that recovery though, man. Holy cow.
I think
That is a candle. That's a wick if I've ever seen one.
That's it.
Mm-hmm.
I want to talk about.
I don't think I've ever seen it like this before.
Americans now have more confidence in the president than the Federal Reserve when it comes to doing what's right for the economy. What
Hell
do you
yeah.
think that is, and what's your response? What's your message?
Our response is we're going to do everything we can to use our tools to achieve the goals that Congress has given us, and we're not going to get distracted by anything. So I think that's what we're going to do. We're just going to keep doing our jobs.
All right. One more question.
Comedy.
Yeah, it is comedy, isn't it?
Your views expressed prior to the meeting. I think there was a lot less dissent today than a lot of people expected. It'd be good to know just what you think the drivers were, coming to a very strong consensus.
The wave indicator is saying that NQ or QQQ is going to go up to 24638. That's the price target that it just printed for me off the lows here for this call.
What about QQQ?
Let me check.
One side.
It's probably the same thing.
Today.
Yeah, it's predicting 593 as a price target, which is right. That's confluence with my guess too.
Yeah, just retracing this top, hitting the top at least.
Mm-hmm.
You could still say, and did say in July, the time of the July meeting, that the labor market was in solid condition, and we could point to 150,000 jobs per month and many other things. I think that the new data that we've had, and it's not just payrolls, it's other things as well, suggests that there really is meaningful downside risk. I said there was downside risk then, but I think that downside risk is now a reality, and there's clearly more downside risk. So I think that's broadly accepted. And so that meant different things for different people. Some wrote down, almost everyone who wrote down supported this cut, and some supported more cuts and some didn't, as you will see from the dot plot. So it's just that's just the way it is. And people have, you have people who take this work very seriously, think about it all the time, do their work, discuss it with our colleagues.
That's good. They take it seriously and discuss.
We ourselves.
Makes me feel better.
We actually act like this is our job, and we.
It's all so nonchalant. Is that it?
Gosh.
Very unsurprising given
These are people's lives, Jerome.
historically unusual nature of the challenges that we face. But let's remember though, the unemployment rate is 4.3%. The economy is growing at 1.5%.
I wonder if mortgage rates are going to come down.
It's not a bad economy, right?
Pull up the 10-year.
Challenging economic.
It's going up.
Policy standpoint of what we're trying to accomplish, it's challenging to know what to do. There are, as I mentioned earlier, there are no risk-free paths. It's not incredibly obvious what to do. So we have to keep our eye on inflation. At the same time, we cannot ignore and must keep our eye on maximum employment. Just so that those are our two equal goals.
Bodine, you're exactly right.
Views on what to do. Nonetheless, we came together today at the meeting and acted with a high degree of unity.
Yeah, SPX is now flat for the day.
Mm-hmm.
SPX?
Yep.
Yep.
Yes, that's break-even rate. So I'd be curious to hear a bit more about that.
There's more volume. Well, nah.
Yeah,
It's
so
hard to read. I can't read. I can't trust any indicator right now during this. I'm serious. You'll get burnt, man.
Look at NDX though, dude.
What? NDX? That's the Dow, right? The Boomer Dex?
Right.
No, that's
It's,
NASDAQ.
NASDAQ.
Oh, that's NASDAQ.
It's the European version of like SPX for Q, or a European version of QQQ.
Oh, it's down.
That's because parity.
Well, NDX is you can pull up the
labor force really
actual index for NASDAQ, or you can pull up
the supply of labor was coming from over the last 2 or 3 years.
These are neutral candles here on SPY.
NQ?
NQ2.
Together,
Yeah.
so
NQ is the future.
You have inflation, unemployment ticking up outside, just one tick outside of the range where it's been for a year. 4.3% is still a low level, but I think this speedy decline in both supply and demand has certainly got everyone's attention.
Well, you mentioned it's
Speedy decline.
but it's striking the measures of kind of activity and output of the quarter, those that we have see pretty strong in Latin America's GDP now, it's very strongly, strong EC numbers as well. How do you square those things? Is there a chance actually the outside risk to the labor market if those activity measures are around?
Well, that would be great. We'd love that to happen. So I don't know that you see a big tension there, but it's gratifying to see that economic activity is holding in, and it's a good bit from consumption. It looks like consumption was stronger than expected.
Ooh, voting. Hell yeah, dude.
Yes, and also we're getting a fairly narrow sector is
Good work, man.
A lot of economic activity, which is the AI build out and business investment. So we watch all of it, and I would say we did move up. There's a median for growth for this year actually moved up in the S&P between the June and September S&P. So and really the inflation and labor market didn't change much. It's really the risks that we're seeing to the labor market that were the focus of today's decision.
Hi, Nicole Bigpine of Barron's. Thank you for taking my question. Given the cumulative impact of high interest rates on the housing sector, I'm wondering how concerned you are that current rate levels are exacerbating housing affordability issues and potentially hindering household formation and wealth accumulation for a segment of the population?
That's not in their purview.
Housing is an interest-sensitive activity, so it's at the very center of monetary policy. When the pandemic hit, when we cut rates to zero, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going, was that
I bet they were
cut so aggressively.
Yeah, their sales went up like crazy.
Yeah,
we're so thankful.
And we raised rates, and you're right, it does burden.
That's why the cost of housing is up 200%.
Right, yeah.
And judging by this meeting today, I don't think that's going to get any better. They're cutting rates some more.
Rate changes do tend to affect mortgage rates, and that has been happening. And that'll of course
everything goes.
Borrowing rates for builders will help get builders will help supply, and so some of that should happen.
I believe they just bought this pullback.
We have to be pretty big changes for it to matter a lot.
Could be wrong though. Don't take my word for that.
To matter a lot for the housing sector.
Oh, that sucks.
The other thing is by achieving maximum employment and price stability, that's a strong economy. That's a good economy for housing. And then the last thing I'll say is, if there's a deeper problem here, there's not a cyclical problem that the Fed can address, and that just is a pretty much nationwide housing shortage. There are a lot of places in the country just don't have enough housing. for people. And you know, all of the areas around metropolitan areas like Washington, for example, are very built up, and so you're having to build farther and farther out. And so that's where it is.
It's been that way since '08, Powell. Tell us something we don't know.
Press conference following the last SCP seemed to indicate that policymakers lacked conviction about their projections, and I'm wondering if you still feel that way.
You know, forecasting is very difficult, even at placid times. And as I mentioned before, forecasters are humble, not with much to be humble about. So I think right now is a particularly challenging time, even more uncertain than usual. And so I don't know any forecaster anywhere really. Ask any of the forecasters whether they have great confidence in their forecast right now. I think they'll honestly say no.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. If you're cutting rates, why continue to reduce the size of your balance sheet than pause the unwinding?
Well, I think we're cutting the size of our balance sheet quite marginally now. As you know, with the balance sheet, we're still in abundant reserves condition. And we said that we would stop somewhat above somewhat above an ample reserves level. That's what we are, and we're getting closer to that. We're monitoring it very carefully. We don't think that has at all.
They monitor things very carefully.
Yeah.
But only when they need to.
Yeah, oh yeah.
So much double talk, I tell you.
Yeah,
it is, man. Yeah, you can.
I think we got enough out of that.
I think we did too. Let's get into the boring part.
Oh man. All right. Well, looks like we're pretty much flat. We had a pretty crazy day. We're going basically to zero in terms of, well, we're going to flat. Let's see what's up on the FinViz. Where are things holding right now? Looks like the consumer defensive is still doing good. KO, man. So
financials are doing all right.
Yeah, financials are good. Wow. Yeah, they're not getting hurt at all, man. Visa, JPM. Man, these things are just cranking. So financials and the consumer defensive. You look at some of the other companies though. Microsoft is rebounding. I think Netflix is holding up pretty good. I mean, what a mixed bag. Really, I wouldn't say this is like triggering a rotation or anything into the defensive, into the financials. We still have a few bright lights. What's Apple doing in the tech heavy sector? But I don't know. What are you thinking? A rip tomorrow after a little sell off? More of a sell off after this recovery from the rip? From the dip? A rip from the dip? And then a rip?
We could just return to the trend we've been doing for the last 2 weeks, 3 weeks.
Yeah, I mean, if the market was pricing in 25 basis point cuts, you have to think that even this significant intraday movement, it was already, this is nothing really. We already knew all the stuff he said about the labor market, the tariffs. So, yeah, I wouldn't be surprised if we open up green again tomorrow.
Numbers are all made up. Don't matter.
Yeah.
And we did this was a 1.5 point pullback, basically. If you go top to bottom from a couple days, 2 days back to the bottom today, almost a 1.5% pullback.
Yeah.
Getting close. It depends on which chart you're on. On SPX.
I mean, 1%, 1.15%.
I mean, fair pullback.
Yeah.
Buy the dip. Keep going.
Yeah. Yeah, I don't think this is going to derail anything. I think really the only thing that could have changed like a fundamental part of this trend was 50 or 0. We got none of those. We got the 25. So, meh.
Inline, already cooked in.
Yeah. Yeah.
Market
So this,
says, yeah.
yeah, exactly. Yeah, Bodine, a lot of movement, a lot of movement to do absolutely nothing.
I don't think that this is kind of where economics numbers don't really matter for the market lately.
No.
Somebody was asking about the jobs, how to play it tomorrow. Like, I don't expect much of anything tomorrow.
Yeah, I mean, if that latest jobs report didn't, I mean, we didn't stop the market from going up, why would this new one, or the revision rather, last week? XOM's looking kind of nice though.
I think the next big catalyst we got is financial earnings coming up next month. So
yeah,
we could just float along until end of the quarter here.
Yeah, man, it's already that time almost again. Yeah, good quote. Bodine is saying the market today, quote, is a tale told by an idiot, full of sound and fury, signifying nothing. From Shakespeare. Yeah, that's a pretty accurate analysis there, Bodine. I don't know. All right. Well, I mean, I'm holding on. I was, kind of holding on, really opening any super swing positions, but now that we're here, I guess it's time to look at some. Chevron is a nice little trend right now, actually.
They act like their balance sheet is weak, but they got $6.6 trillion on the balance sheet. Tomorrow at tomorrow at 4:30, they're gonna have a new update on that.
Chevron?
No, that's the Fed.
Oh, the
central
Fed.
bank.
Yeah.
Central bank balance sheet. $6.6 trillion on the Fed balance sheet.
That's crazy.
But that's light compared to what they've had.
Yeah, it was like 13 trillion at some point, I think, or it was really high. I don't know, maybe it wasn't that high. It was high though.
Well, everybody.
You think Chevron? Yeah, you think Chevron will continue to fill this gap?
I mean, go with Jack Carter's theory. All gaps eventually get filled. Almost all, I'd say.
Yeah.
I mean, oil and gas supposedly drill, baby. But I was reading over the weekend that oil projects in the U.S. need $68 oil to justify spending, and we're quite a bit shy of that right now.
Yeah, where are we on?
63.80 right now, potentially dropping. So that, unless we rally up, that's people are going to be shy on investing. It's kind of funny. The solution to higher prices on commodities are higher prices. That encourages more people to invest in the production of those commodities and everything except Bitcoin. And lower prices of commodities tend to increase demand, which causes prices to go up. So
yeah, especially oil is a weird one because like policymakers want it to go lower, but the companies don't want it to go lower.
And if we have a big spike in oil, that's like the number one feedstock for inflation. Powell's like blah blah blah, completely dismissing oil, and oil prices are like the highest influence on inflation numbers. So if we get any kind of spike in oil, then inflation is going to rip. So
yeah, gas has been pretty. I mean, it's been like the same price for 2 years where I am, exactly the same price.
And gasoline itself hasn't really moved. RB on the futures chart, RB if you want to pull it up. And it's actually sitting down at the lows it's been at for 2 years.
RB or RB? It's probably a
RB RB1, RB1 exclamation.
Robin Bravo.
Robin Bravo at 1 exclamation point to get the future to pop up. There you go.
Yeah, it is pretty low. Look at that.
Sitting at the low end of the range we've had for a couple of years.
Yeah. Trying to see if there's any good.
Yeah, interesting though. Heating oil, which is diesel fuel, it's Hotel Oscar 1 exclamation point, is actually on the rise.
Is this it?
Yeah. You see, it's actually near the top of the range we've been at for a couple of years, barring the couple spikes there.
Yeah.
So diesel fuel demand much higher than gasoline. It's interesting.
It's probably good for trucking and shipping, I would think.
I mean, higher gasoline prices or higher diesel fuel prices, that's not necessarily better for shipping.
Well, it means like there's more shipping.
Yeah.
There's more
Indicates
freight.
there's demand. There's demand for diesel, at least going right now. But we are way off of the highs for the last 3 years.
Let's see if there's any interesting put flows that came in the last hour. Yeah, nothing super decisive here. Besides Target. Is Target gonna make a comeback? Got some Palantir. Yeah, nothing really. I thought there'd be more like a better mix of stuff. Got some Palantir calls coming in. I don't know. So CVX.
It just seems like a nothing burger day. I mean,
Yeah.
it's kind of what I expected. That's the way the last 3 or 4 FOMCs have gone. Just a lot of nothing.
No, I mean, people are calling this the most important day in the markets for 3 years.
Yeah.
What a letdown.
Well, that's why it was a letdown, really. Everybody expected the hype. And, it's like it's the underserved ones that are usually the big movers, and the ones that are all hyped up like end up being nothing.
Yeah.
Mm-hmm. And we've been talking about it too, like everything was already kind of priced in,
Yeah.
Yep.
So this makes sense. I mean, I still think we make a run for the highs, but from there, it's destination unknown.
Yeah, we could go up and tag a new high again and then fold
Pull
it.
back. Yeah, it's possible.
Especially if we go spike a higher high than the initial move, that could set up a bigger correction here.
Ha! Nice. And we're green on the SPX.
Yep, we just flipped green.
I was sitting there, NASDAQ and SPY kind of both flip green there.
Oh, look, JT, there's one for you in the chat from Rob.
Let's see.
Nice.
Yeah.
Help from Sledge, the man.
Yeah. K-Web doing nice.
That's good.
That's pretty funny, Bodine, what Roger said. Yeah, I mean, that's basically they have no clue. We have no clue. We're all just passengers in the dark.
I mean,
Powell deserves a gold medal.
For what?
For his ability to say nothing in so many words.
Yes.
For acknowledging that both inflation and the job market are problems, and we're siding with the job market over inflation.
Yeah.
Yep.
I thought they should do nothing since it was so in between, but whatever.
Yeah, it wasn't. I don't know. It was not a very big vote of confidence for their. I mean, what I kept on saying. We study things a lot. It's like, okay. I don't know. I guess there's no. I mean, what else are you going to do? I don't know if there's any more. That's the whole part of central bank policy is you're trying to get these people to study it and make their own decisions based on this imperfect data that they can barely understand. That's probably not even collected in the right way or has any indicative predictive power. But instead of letting the market decide what interest rates are and what they should be. Which
Yeah.
I think if the markets decide, if I think you could argue the 10-year is the market deciding what interest rates should be rather than the Fed, which is kind of what's cool about the bond market. It's it kind of is the real market. So, yeah, I mean, even bonds kind of retraced. They were up, they were up at the top of that wick. Now they're down a little bit. I don't know. I think we're still in a bull market. I've been saying this. I think we're going to drift higher until 2026, the midterms at least. So, yeah, strap in, folks. I don't see anything. There's nothing to derail.
Nope.
And I'm not saying there's anything to cause another what we saw from in the last since April. And that was a huge run, but it's just just bottoms are events and tops are processes, right? We're just gonna keep on grinding up that process.
Yeah. Just
Yeah, nothing good on that CVX spread. That's not a good one. It's too expensive, too wide. I don't really. I don't
what's
even know
KRE doing? Alex, check out KRE. How's that
Regional
look?
banks.
Yeah. What are they doing on the daily chart? Not the daily, but the intraday, 15-minute. Yeah, you can look at that too. Okay, so they sold off a little bit.
Yeah, I mean the JPMVs of the big boys are up. These are down. I don't know if that's related to Fed balance sheet stuff. I don't know if the Fed buys. I guess they do. I guess they do because they backstop Silicon Valley Bank. I guess they do interact with regional banks too. I have to do some research. I'm a little rusty. I haven't dove into the Treasury market in a while.
I have not either.
I was doing a lot of it. I was just studying a lot of it back a couple of years ago when Silicon Valley collapsed.
Yeah.
But no, stocks are more fun.
I agree.
Stuff's dry. We still got MU climbing, PDD. What's PDD do?
That's Timu.
Timu. Oh, okay. What's the Labubu Pop Mart? What's their ticker?
I'm not sure.
Lance asked me about that one at one time. I don't know.
I'm bullish on Labubus.
Positive sign for the economy.
You never know anybody have a Labubu in the audience? You know what a Labubu is? These little demonic Chinese dolls. People are going crazy.
You can get the knockoffs like crazy on AliExpress.
I bet those are the exact same ones.
They're made in the same place.
Right, they're made in the same place. A little worse stitching, maybe. I don't know. Ooh. Funny. IBM. Huh, that's an interesting one.
I don't know if this is the right ticker or not, but PopMart 80 on the Thailand exchange.
Nah. The Boo ticker would just be going straight up. Can't imagine it going down like this. But it probably is. I swear I found the US ticker, but I can't remember what it was.
Hold on. Let me Google it.
If all else fails, ask Google.
Labubu doll ticker.
PMRTY.
PMRTY.
Oh, it's a crypto.
It's a what?
It's a cryptocurrency that's associated with Labubu. It's LABUBU Labubu -USD. Right there.
PMRTY is the OTC listing for PopMart International Group.
Yeah.
Oh, is it?
Yeah, that's PMRTY.
It has pulled back.
Yeah. It's only $33.
Only. Looks like the liquidity's crap too.
Yeah,
Yeah.
look at that chart. I don't like that chart. I do like, I mean, IBM though, look at this one. Where did I go? Let's go back to IBM. Man, that's a huge gap down, even though they had good earnings. I don't know what their forward guidance was, but I don't feel like looking at it. I'll have to look at it later, but I mean,
Baidu's got a nice breakout going. Exponential straight up.
Do you buy breakouts like that?
I was already in K-Web, so I played Chinese breakouts a few days ago.
Would you buy breakouts when they're already here though, like this?
I mean, I did it when it started. K-Web,
Yeah.
I got last, I guess Friday or whatever it was when it started to break higher there. And you know, I played a 41-47 call spread, debit spread.
Nice.
So I still have room to the upside. It was like I think it was a 7-to-1 risk reward.
You're still in it?
Yeah, I'm not giving up yet.
Nice.
That's the one Robinson was in the chat there talking about. Took the 119% profit. He's in my inner circle group. Let's see. Let me pop back over, find KWO. See what it. Yeah, I'm up 123% right now.
Oh yeah.
Played October 41.47. Bought at 96 and it's at 214 right now.
That's sick. And we got some moves coming on AMAT too. Man, a lot of these stocks that just sold off at their earnings are coming back. Completely retrace that gap. Man. Well, folks, I mean, now that the Fed's done, what are the big events? Earnings are the next one, but we have plenty of time to make some trades. So, one of the ways I use when I do technical analysis, I use limited technical analysis tools to find trades, but one of them is something I call the X pattern. Now, last week we got it. Now that we have finished FOMC, we have a new trade coming this week. Using this last week, closed out this. It was really just an intraday, nice little 25% debit spread winner on Lumen. Last week we got it about right here, midday, and then it popped, and we got just immediately filled on good to close order. So I call it the X pattern because it's pretty easy. You just look for an X, and when that X appears, that's when you know to buy, right? And so it's basically like old treasure maps. So we have it teed up. Blake, you want to start rolling that footage because it's I teach you how to use it, what I look for.
Yeah, of course.
And yeah, so we're gonna I'm actually getting another trade lined up on that. I'm gonna go get it out tomorrow actually. So it's gonna be pretty cool.
Heck yeah. Well, I can tee it up if you guys are ready.
Let's do it.
Let's do it.